It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no. If you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold.
We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and share your thoughts about the video in the comments section below. Thanks and enjoy the video. The renowned economist Jim Rickards continued her speech as follows.
So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. We've gone back to the 1920s or earlier through most of the 19th century. For the United States, in sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold.
So, if you were a citizen, they requested you to deposit your gold in the bank, and they provided you with paper currency. However, individuals did this out of a sense of national duty during an existential conflict. It's not a typical market situation. In the event of losing the war, your concerns extend far beyond your gold reserves. Therefore, people entrusted their gold to the banks. How did the banks respond? They melted it and crafted 400-ounce bullion bars, assuring, "Don't fret. Your currency is backed by gold, but continue using this paper money." Nevertheless, it's redeemable for gold. Yet, just to point out, 400-ounce bars are not practical for daily use. I'm certain you've come across one, and I've encountered them as well. They're unwieldy. They weigh around 35 pounds. Carrying them around is infeasible. Consequently, the gold remained within the banks, and that's the initial phase. In the next step, which occurred in the 1930s, central banks confiscated the gold from commercial banks. Initially, commercial banks took gold from the public. Subsequently, central banks claimed the gold from commercial banks, and the Federal Reserve System absorbed all these institutions. They instructed, "Please dispatch your gold to the regional Federal Reserve Bank." Predominantly, most of it ended up in the Federal Reserve Bank of New York. At this point, it's no longer within the banks, right? Nonetheless, you're still under the impression that your paper money has some connection to gold, although people haven't laid eyes on gold for a considerable period unless you're a collector. In the third phase, the United States Treasury and Finance Ministries acquired it from the central bank. In 1934, the United States Treasury confiscated the gold held by the privately owned Federal Reserve System, in exchange for which they received a gold certificate. If you presently explore the Federal Reserve System's website and navigate through their links, you'll discover it. Examine their assets, and the foremost entry is the gold certificate, valued at $11 billion. However, this valuation relies on an assessment of gold at $42 per ounce. If we were to reevaluate it, the estimation is that this $11 billion is now actually worth $470 billion in today's market. Hence, the Fed possesses a concealed asset of approximately $450 billion that doesn't appear on its balance sheet, represented by a gold certificate. Nonetheless, the gold itself is in the hands of the Treasury. Incidentally, where do we store our gold? In the context of the United States, the Treasury retains ownership of the gold, the Fed holds a paper certificate, and the actual gold is secured at two military bases, West Point and Fort Knox. Consequently, I'd assert that the military is in possession of the gold. Gold has transitioned from being carried by citizens in their daily lives to commercial banks, central banks, and finance ministries, ultimately safeguarded on a military base. It's still in existence. Gold hasn't vanished. Nevertheless, it's a subject rarely discussed, and people tend to ignore its monetary significance. But, in reality, it is currency. Meanwhile, what's occurred among the general population, the citizens? We've ceased discussing it. We've stopped referring to it. We've ceased educating ourselves about it. I'd like to remind you that, while it might reveal my age, I obtained my postgraduate degree in international economics, graduating in the class of '74. Coincidentally, that's the same year the IMF delinked gold from its monetary role. Yet, I was part of the cohort that received instruction in gold as a monetary asset in an academic setting. If you're younger than I am and have knowledge about gold, it's either because you've acquired it independently or because you attended a specialized institution. This is because teaching about gold came to a halt. Presently, we have two successive generations of scholars who have no familiarity with gold. They've concealed it. They've seized it. They've buried it. They've ceased educating about it. They've ceased discussing it. And they've pretended as though it's insignificant. In reality, it persists, and Russia is a prime example of a nation that takes it earnestly. In the United States, we still retain our 8,000 tons, precisely 8,133 tons. We haven't relinquished it. We haven't sold any gold since 1980.
Don't forget to like our video and subscribe for our channel.